Hi, everybody. Thanks for being here today. I'm Susan Geist, and with me is Caitlin Muldoon,
Hey
and
everyone.
we run Rising Femme Wealth. And we thought it would be great. We met a lot of great women at the Texas Women's Conference recently, and we thought it would be great to address some of the questions we got there about investing and retirement and tax strategy. So we thought it would be great to have a call with you guys and be able to talk to a group to answer some of your common questions. So to get started, one of the big questions that we received is, how do I even get started on my wealth building journey? I think a lot of women especially don't receive a lot of financial education along the way. And then, you start a job and they just put a bunch of papers in front of you and say, okay, check some boxes on where you want your retirement to go, how much. And there's not typically a whole lot of explanation about what's actually happening. How do you actually start building an investment portfolio? How do you get where you want to go? So essentially, there are four main paths to wealth building. And the first path, of course, is to save more than you're spending. Living under your means, that's essential, right? To be able to even start saving money. So, spend based on your budget and then save the rest. A high yield savings account is a great place to start saving your money. It typically will give you much more interest than just a checking account. High yield savings account are paying between 4% and 5% right now. So it's a great place to just, as you start getting a little more money, to put it to begin with. Paper assets are the next way that you can start building your portfolio, and that'll be stocks and bonds. And when you're investing in the stock market, index funds are typically a great thing to invest in. They are low fee and low maintenance. So rather than paying a mutual fund manager a fee for managing your money, a fee for buying into the mutual fund, a load fee, all these extra fees, the index fund, it's indexing the market, right? So you're getting a piece of a bunch of companies, and in exchange for that, you're not paying someone to have to manage your money. So it's much lower fees. And Caitlin and I actually have a really great index fund chart. If you wanted to pull that up, Caitlin, we could take a look at that.
Yeah, let's take a look. Get it shared here. Here's our index funds quick guide. So these are just examples of index funds. These are certainly not recommendations to buy any of these. But when people ask about what is an example of an index funds or what kind of index funds are available to me, we get that question so often. So this quick guide really just gives you a rundown of examples of different kinds of index funds based on different brokerage accounts that you might have, as well as based on what you're wanting to track. Susan, I just jumped in there, so I'll let you finish your thought on index funds.
Oh, that's great. So ETFs, especially, you'll see here the Vanguard ETFs, they're the easiest to trade in the stock market. You can trade them any time of day versus these mutual funds, index funds that you'll see that end in X, those trade at the end of the day. So the Vanguard ETFs are easy to trade. You can trade them at any brokerage, usually without a fee. If you are choosing to go with the mutual fund version of the index fund, typically you want to stick with your brokerage. So if you have a Fidelity account, you'll want to buy the Fidelity index funds. They'll be much lower fee to do that. Typically they charge a higher fee to buy someone else's index fund. But the ETFs are super easy, great way to be able to buy an index fund at any brokerage. And like Caitlin said, these are common ones, probably the most popular ones right now in the US. And so if you just want sort of hands-off, easy way to manage your brokerage account, these are a great way to get started.
And what you can see on the top of this chart, these are different markets that these funds are tracking. So the index funds are a collection of different stocks or bonds that are going to represent different aspects of that particular market. So you could see that there's a total US stock market, and there are index funds that are a collection of stocks that track the total US stock market. There's the S&P 500 funds, which track the S&P 500 market. Same goes for the total international market, total bond market. So that's the idea of an index fund. All across the top there are the different markets that those are tracking. So that's just something to give you an idea of how you can take a look. By the way, it doesn't matter if you, as Susan said, if you have one account, it doesn't mean that you can't necessarily buy index funds that are offered by another brokerage, but there could be scenarios where you might be paying higher fees. But I would always start by, you can go ahead and Google these. You can use morningstar.com as a resource to be able to research some of these and get an idea for what their risk profile is, what their risk reward profile is, what kind of growth you might expect to see. You also can find information about fees and who's managing these funds. So it's a great way to start. Once again, it doesn't mean you should go and buy any of these, but it certainly gives you a way to kickstart some of your research.
Yeah, thanks, Caitlin. And moving on from paper assets. So the downside of paper assets is they do typically take a long time to grow. They're a great place to put your money, typically, but they will get you to retirement, typically at retirement age, right? So the market will grow, maybe over time, 8 to 10% per year. So by the time you hit 65, you should have a pretty good nest egg if you've been consistently investing. But if you're looking to retire earlier, oftentimes you have to go in a different direction. And so the next path to wealth is real estate, which we'll talk about a little bit more in a second. And then, of course, the final path is starting your own business. And pretty much all the billionaires that exist because they started a business or invested early in a business. There's unlimited income potential when you have a business, and there are huge tax advantages to owning your own business. So if you think about, say, two different columns, right? And so you've got being a W-2 employee where you get a salary, taxes pulled out of that, and then you have your expenses. When you have a business, you've got your business, you've got your expenses pulled out next, and then you're taxed on the rest. And so you can see there's a huge tax advantage to owning your own business. So that if you want to be a billionaire, that's typically the path to take. So to review, the 4 different paths are save well under what you're making, invest in paper assets, look at real estate, and start a business.
I would also add a little bit more to, I love that conceptual overview of like, these are different ways to build considerable wealth and potentially allow somebody to retire before the typical retirement age of 59 and a half into 60s. Also, I want to dive into more of a tactical level, just because we get a lot of questions about this too. How do I know when I'm ready to invest? And then there are so many options out there. Like, what are some steps that I need to take to just really limit down what my options? Like, just point me to my first 1, 2, and 3 checklist. So one thing that I'll add as sort of a list to that, and in addition to what Susan shared about those different strategies for really starting to build a lot of wealth. One as you start your investing, ensure that your high interest debt is paid off, because a lot of times people try and get really creative and they spend a lot of time researching what they think is going to be like the next best thing in their investing, when it turns out they're still paying, 17% interest on credit card debt or more, or maybe they got a HELOC that has really taken off and potentially they're paying 9% interest on a loan. Well, guess what? If you're investing in an asset that is returning you 10%, then that's really just a 1% spread if you have a 9% loan. And actually, you're losing 7% if you're still paying 17% interest on high interest debt. So, first and foremost, always make sure that your high interest debt is paid off. It's going to save you the time and the worry about all of your investing research, and really just allow you to focus on paying that down. That's going to be the best return for your money, most likely. The second step is ensure that any funds that you've allocated to retirement already are invested. So I never want anyone to feel silly or stupid for hearing this, because I've been there too. I remember that feeling when I realized that I had invested in my IRA. I had put funds into my IRA, but not invested them. And knowing that you have funds that you worked really hard to allocate to retirement and they were sitting there and actually not accruing interest, it's a terrible feeling, but it means that you can just stop that feeling right now and make that money start working for you. So go back to the retirement accounts that you already have, funds that you already have invested. So this is low hanging fruit, y'all. You don't have to go and try and get to a higher savings rate and invest even more. There are ways that you can go out and make sure that the money that you've already allocated to retirement is actually invested, and invested in the way that you want it to be. So check out your IRA accounts, check out your any other retirement accounts that you might have, 401k, 403b, simple IRA or SEP IRA, and make sure that the funds are not just sitting like in a money market account, and that they're actually invested in a way that aligns with your goals and your values. So if they are invested, say, beyond a money market account, they're probably making a return that tracks closer to how our the S&P 500 has been tracking, for example. So if you're looking at those accounts and you're seeing that the returns are way lower than that, then you might be invested in a way that is too conservative for you. So you might be invested in more bonds than you want. And if you feel like your risk profile is higher than that, and you're like, I don't need this money for a long time, and I really want to see some more growth there, and I'm willing to step up my risk profile a little bit. I want to see my returns coming in more. Then you can change that allocation within the accounts that you already have. So definitely make sure that you're going into the accounts that you have, making sure that the funds that you have in those accounts are invested, and invested in the way that you want them to be.
Yeah, that is so important. My hairdresser was actually just telling me last week that she had opened a Roth IRA 20 years ago because someone else in her beauty school had told her to do it, which is a great thing to do. And she went back in the other week and discovered it hadn't grown at all, and she didn't know why. And it turned out it was just put in a cash account and never actually invested in the stock market. So I think that's such an important point to know, is that with an IRA, because it's your individual retirement account, you are responsible for investing that money. It's not like a 401k at work where they're going to give you these options and tell you, you've got to pick one of these. You're responsible for actually putting your IRA in that investment.
Totally. And you know what? I feel so much for her. Good for her, because she took those steps to invest that money. And I know that's got to hurt to know that it's been sitting there for 20 years. But hey, that's money that she still put away, saved, didn't touch. And then hopefully, this is a lesson now that she talks about and is sharing with other people around her. And that's what we're doing here too. Make sure that you're going in to any of those accounts, especially like Susan said, your IRA, because you don't get that default allocation from an employer sponsored account. So in an IRA, you're responsible for making sure that those funds are invested. And by the way, if you have questions about how to invest that, think about, some of the index funds that we talked about earlier too. Just start doing a little bit of research there. That's I think that's always a great way to start. But again, do your own research, do what's right for you, and you can, you don't have to be the expert to just get started today. Just remember that time is your friend. So if you wait until you say, I need to be an expert first, you are missing out on some of that time. So the third thing that I want to highlight is utilizing retirement benefits that are available to you. First things first, if you have a company match available, take it. That's free money. Okay. So if your employer is saying they have a 4% match and they are matching your contributions up to 4% of your salary, that means if you're not contributing up to 4% of your salary, you're not getting that match. So make sure that you are maxing out your company match. That's free money. It's such a great way to grow your retirement fund. And then
Yeah,
second,
that's part of your salary. So definitely
totally.
take advantage of that. Because if you're not taking advantage of that, you're letting your company out of having to pay you part of your salary.
Yeah, absolutely. Um, Invest in an HSA if you're eligible. So if you have a high deductible plan, you're likely eligible to have a health savings account. And what that means is that you're able to um, take contributions, deduct those from your salary. So it's a huge tax advantage. The second tax advantage is that it grows tax free in that HSA account. And when you go to use those funds before retirement, if you're using them for healthcare, then you're actually withdrawing the funds that have grown tax free. So, I mean, there's really not another account that operates in a way that a health savings account does. That's why we call it a triple tax advantaged fund, is because you get tax advantages at those three different points: a deduction from your taxable income. You get to grow your money tax free, withdraw it without penalty and without taxes, as long as you're using them for healthcare expenses. After retirement, you have access to those funds as well, tax free. So one of the methods that I love about an HSA is that if you're able to cover your healthcare expenses out of pocket and keep the money that you've invested in an HSA, it can keep growing and growing and growing tax free. So it's a pretty robust benefit. If you are able to take advantage of an HSA, I would say do it.
Yeah, and one note I would make on that is it does work the same way as an IRA, where you have to go in and invest that money. So
Thank you.
its default is kept in a cash account. So what I did is I kept some in the cash account that I knew I was going to have some expenses coming up, some health expenses, and then I took the bulk of it and moved it into an investment portion of that HSA to just let it sit there and grow for a while, so I could use that money in the future.
Yeah, thank you. And that's a big part of maximizing your tax savings. Another way to circle back to those retirement benefits is maxing out your retirement plan contributions, 401k, 403b, and then also for IRA contributions. Being able to max out your eligible contributions to an IRA can really help reduce your taxable income and therefore reduce your tax bill. And the reason that those programs exist is because we're being incentivized to save for retirement. So these are really great tools that we have to take advantage of. And I want to add that getting comfortable with a slightly higher and higher risk tolerance is a really great practice of investing too. That doesn't mean, be irresponsible with the way that you invest, but so many people they get really uncomfortable when they start putting money, say, into the stock market, into different funds. And the reality is that you can actually risk even more if you're not investing your money and instead putting it away in savings, or even if you put all of your money in high yield savings, the likelihood is you're risking a loss of your money because you're likely to return way more money than a high yield savings rate would get you on your investments. And doing so for the long run can really cost. And therefore, I like to flip that argument on risk when it comes to, I'm a little bit risk averse and I'm tentative to invest. And first of all, I think that we all have so many different reasons for feeling that way, based on our culture, based on the way we individually have been raised and what our personalities are. So that's never a wrong reaction, but it is something that we can slowly start to work on and practice, taking slightly more and more risk as we're comfortable. And just making sure that we're checking in on that feeling and making sure that that tracks with reality, and seeing the data to back that up in terms of what is the risk of really losing all of your money, say that's invested in the stock market, and then what is the risk of always just having your money invested, say, in a high yield savings account, and looking at those different scenarios and seeing what the real data is in terms of what historical average returns have been. And those can paint a more realistic picture for us to help us taper down some of the fear when it comes to investing and starting to take some of this risk.
Yeah, that's such a great point. I see we have another question here asking about what percentage of your money you should be investing. So I don't know if you wanted to speak
Yeah,
to that.
that's such a great question. So, first of all, there are kind of two ways to answer this question. One is that it absolutely does depend. Two is that we can kind of refer to the 50-15-5 rule as just a guideline, if you've heard of that. So that means that 50% of your take-home pay should be allocated to essential expenses like housing, food, healthcare, transportation, childcare, debt repayment. 15% of pre-tax income gets invested for retirement. And then 5% of take-home pay is then used for short-term savings, like what you would put in an emergency fund. And then this, if you're doing the math, actually adds up to 70%. So that leaves 30% of your income that can be used for discretionary expenses like entertainment, vacations, having dinners out, and then being able to contribute more to savings. So what I don't like about those formulas is that everyone's situation is so different. And childcare costs are insane these days, and so are housing costs. So I don't think you're in a bad position if you're not exactly abiding by that formula. So please don't take it that way at all. I think that it's nice to use that as a guideline. If the way that I would look at it is that if you invest as much as you can while feeling comfortable that you still have, the amount of money that you need in an emergency fund, making sure that you're paying off debt. So, like I mentioned before, high interest debt needs to be taken care of first, but making sure that you have kind of a buffer for things like mortgage payments, other car payments, other debt that you might be taking care of. And then, if you can contribute more than 15% of your pre-tax income because you're still allowed to, because your contribution limits haven't been met, and because you feel like I have this excess and I want to continue to take more advantage of tax benefits, then you can absolutely do that. Or instead of using more than 15% of your pre-tax income for investment, you can flip into the other side. So if you do have 30% that's left over for discretionary expenses, maybe see how much of that 30% you can really start to allocate towards an investing plan. And maybe you get to a point where you even want to invest in more than your retirement plans, more than your taxable brokerage, and see what else is out there for you. A lot of our clients are curious about alternative investing, including real estate. So you might have a fund that you're saving up to buy a rental property, for example. So I would definitely recommend having money like that, not just sitting around. If you can put it in a high yield savings account, if you know for sure you're going to deploy that money for an investment in the very near term. I think having it in a high yield savings, or if you do have a high yield money market account, I think that those are great options for just holding and trying to save up something like a short-term expense, including for an investment coming up. I think that that's a great way to do it. There's nothing wrong ever with spending more on your investing plan. So if you're starting to allocate more and more money, that's great. If you've been in a position where, you only recently have been able to put 15% of your pre-tax income and you want to do some catch up, that might be a great way for you to say, this is a reason why I want to put even more of my pre-tax pay into my investing options. So it's definitely, it really kind of depends on what your situation is, but I hope that that kind of provides a little bit of a guideline as to what you might be looking for, how your investment budget should compare to the rest of the expenses that you have.
And I would say definitely don't feel bad if you're not there yet, right? I think it's important to just start somewhere, right? Even if you're starting at $5 a month and that's all you have to put aside for retirement right now, that's great. You're thinking about your retirement and you're starting to invest for your future. And so I think it's important definitely to keep some money to the side. We worked with a client who, she was really struggling to put money into her retirement account, and she just had so little discretionary funds. And she was like, but I really want to be able to buy pizza for my kids once a month. It's $10. And we were like, do that, like that's important, right? So it's important to take care of yourself. But then also, if you have $5 left over at the end of the month, let's, start putting that away. Let's start saving that, putting it towards retirement. So I think it's really important to just be okay with where you're at and move forward from there, right? Even if you're not at a point where you can put away 15, 20, 30% yet to invest, do what you can and just keep moving forward with that, right? Because you're investing in your future. We don't ever want anyone to feel bad just because they're starting at the beginning, right? We all started at the beginning. We all were in debt at one point, and we all had $0 to invest at one point, and one day we had $5 and we put that away for an investment, and then a little bit later we had $10, 100. And so the important thing is just to get started, even if you're not 100% confident with where you're going yet. Just get started and start moving forward.
Totally. And I want to echo that by also reminding you that if you're paying off debt, like if you're paying off credit card debt, which is the nastiest debt of all, you are probably getting the best return on your money than most of us. Okay. Just think about like if you're paying 20+% interest on your credit card debt, if you're paying that debt off, that's the best return that you're probably getting for your money right now. So don't feel bad about that. I hope, in fact, that you feel like this is great. I'm getting a great return on my money. I'm paying this debt off. So, don't feel like you're getting behind. You are absolutely getting ahead by focusing on that.
Yes, definitely. And just leading in from that, we had another question about retirement. So we were talking about that. Like I had mentioned before, they were given a form to check boxes on about a retirement plan for their company. They wanted to know, should they go with a traditional 401k or Roth 401k? So typically it has to do with taxes, right? So your traditional 401k, you're not paying taxes on that now, but you will pay taxes on that when you pull the money out at retirement. The Roth 401k, you pay the taxes on it now, but then it can grow tax-free. So typically, if you think that you are going to be in a lower tax bracket now than in retirement, then you should invest in the Roth. If you think you are in a higher tax bracket now than you will be in retirement, then you should invest in the traditional 401k. Because that money in a Roth gets to grow tax-free, if you're younger, oftentimes it can make a lot more sense to go ahead and invest in that Roth. It also is more flexible as far as being able to take out your contributions in the future. You're able to take those out. Typically at any time, there are a few restrictions on that. You can't take out the growth until retirement age. And then it's also typically better, it's a better investment to leave your beneficiaries, right? Because if you leave them a traditional 401k, they have to pay this big tax bill, right? When it comes out. If you leave them a Roth, then the taxes have already been paid and they can just take that money and use that. So there are a couple differences there. But yeah, that's typically you're thinking about your tax rate when you're trying to decide which one to invest in. Caitlin, do you have anything else you'd like to add on that?
I completely agree. It's really about your tax situation. But one thing that I do want to add is that don't let that keep you from investing. Like one thing that I hate is that we have so many decisions to make, and sometimes that just puts us into analysis paralysis, and it just puts a total mental block in front of us. So you're not going to do anything wrong if you invest in a traditional IRA or your traditional 401k. Like don't feel like that's a catastrophic decision. In fact, there have been a lot of studies about how in the end, if you're actually using a traditional investing vehicle rather than a Roth, you potentially have more tax savings that you can then do something with. So if you invest that tax savings differently, if you have more money to save, if you have even more money that you could put into investment, in the end, that could be the same or potentially even beat out having invested in a Roth all those years. So like just bottom line, don't let that stop you from making the decision either way. Just make the decision, go for it. As you learn more and more about investing, you can build more of a foundation, and you can nerd out on the real differences between a traditional versus Roth. In the end, it's not going to be a catastrophic difference. So just pick one and do it, or do both, or the point is to use it rather than to let it be a big mental block.
Yeah, that's definitely a great point, not to get stuck in analysis paralysis and not do anything. So yeah.
Not that I speak from experience or anything.
Yeah, same here. And then, like you said, investing up to that match amount is so important. And that, I mean, when I was in my 20s at my first job, I was like, retirement's so far off. I don't need to be giving them that much money. And I ended up not investing up to the match amount. So they were getting to keep part of my salary. And it burns me a little bit to think about that. So definitely, yeah, just pick one of the two that works better for you. And it may be that maybe you need, more take home pay now, and it's better to forego that tax bill now, and go ahead and do the traditional 401k. So it's really whatever works for you at that time. Both are great ways to invest for your retirement. And so we have another question. This one is about early retirement, wanting to know how much money they would need to leave their 9-to-5 job. Caitlin, do you want to talk about that one?
Yeah, because I'm going to pull up a fun chart here for us. All right. I guess we have a lot of names for this chart. We call it the FI table for financial independence. You could call it the FIRE table for financial independence and retire early table. But this, and actually, I want to spin this two different ways. So I think maybe I'm gonna add a little bit of like um reality dosing to this chart, and maybe Susan, you can talk to the actual fire version of it, and that way we can both tackle this. But as you can see, what, this table really just lays out on the left column, you'll need this much money invested if you want a certain amount of money per month and per year. So first of all, first things first, I think if you are looking for a path to be able to either leave your current 9 to 5 or be able to switch careers and maybe do something that's going to bring you more happiness, but you don't feel confident it's going to bring you as much pay, or maybe you want fewer hours, or maybe you just want to leave your job for a year or two and then go back to work. I think that this can encourage the great exercise of, first of all, expense tracking. So you should be tracking your expenses so that you have an idea of what your monthly expenses are, and then specifically where you're really spending the most amount of money. That's a great exercise to do because it also just helps you realize, like, oh my gosh, I had no idea we were spending this much money on, these subscriptions, or on that level of childcare, or on that gas, in going to that place or that place. I also like that practice because it can really help you categorize how much of your expenses are tied to your job. And a lot of times, what people don't realize is that they're working a job that is paying great money and they feel really good about that. They might have been really, really pumped on their career, but maybe their job is now draining them so much and they're feeling, less gung-ho about wanting to really pursue their career until the very end. But they're also realizing that, I spend not just a lot of energy and stress on my job, but time, but also I'm actually spending a lot of gas to commute to my job. And all the extra time causes me to have to pay for extra uh, childcare, so I'm like paying for the extra daycare or paying for the extra care after school and before school.
Yeah,
Maybe
at my last job, I was working in downtown Austin and I had to pay $15 a day for parking.
Totally. I mean, and those expenses don't seem like much when you think about them at an individual level, but doing the work of really just doing your expense tracking and then being able to categorize that can really also help you understand, like, okay, if my job goes away, I lose that income, but actually I'm also losing these expenses. And sure, you might pick up some other expenses too, but you already know what expenses you have that are essential to you today, and that are you're incurring just to live an enjoyable life, and so that most likely you can continue to get by on your current expenses if you were to lose out on that salary. So you can it's a great exercise in just being able to give you some insight in terms of, like, what are my expenses that are actually wrapped up into my job that will go away even when that salary goes away, if I were to plan to leave my job. So expense tracking, number one, make sure you do that exercise. And then number two, I want this chart. Here's the reason that I say let's switch it up a bit, and I want to like talk a little bit about reality, is that sometimes I think people look at this chart and they're like, are you kidding me? I'm never going to have $5 million invested. Um, and I'm currently, maybe my expenses are close to 200K a year, when I factor in everything, which you should. But what I want to do is talk about how, when you have a certain amount of money invested, first of all, as you start to draw down on that money, you're getting interest on that money that's invested. So being able to draw down on a percentage of that money to use for your expenses is actually not going to drain the money that you have invested, because the idea is that you're still gaining more in interest than what you're drawing down. And that's what this chart is implying. It's based on what's called the 4% rule, which means that when you're in retirement, once you've stopped earning your income, being able to draw down 4% of your investment should keep your investments alive because they're still earning interest, and it also factors in your annual inflation rates. But I want to go back to that reality check, and for those of you who are thinking like, these numbers are just way too huge and there's no way I'm going to get to, $5 million in my investment account. I want you to let your eyes drop down to, smaller, but still not small numbers, lower down in that left column, so that you can get to a point where you say, look, I know that my essential expenses, my food and housing and healthcare and childcare costs, those are closer to 5K a month. And yeah, I want to be able to spend more than that. But I know that in order to survive, my family needs that 5K a month. And maybe I am getting close to 1.5 million in all of my investments. And that I want to be a reminder to you that that's a way for you to break free from a potential 9 to 5 job that is really costing you a lot of stress and time away from your family and a lot of joy and a lot of health. So that is a way for you to see beyond I just need to retire early and I need to get to that $5 million. And I want you to be able to see that if you can even cover your essential expenses with what you have invested, then hopefully that gives you some breathing room to think about, okay, maybe I do have some time to leave my job for a little while and think about what I want to do next, and maybe pick up some part-time work to cover the other expenses, and to allow myself a little bit of confidence to think in the long term, like, oh my gosh, I can't be unemployed from now until forever because my family is going to need some money. But to be able to think, I have this buffer because I have this much money invested, and that means that I have these monthly expenses covered. And I'm not just taking money out of my investment account and it's totally drawing it down. Like I am covered, and I can really live off of that investment account based on what these essential expenses are. So that's another way of looking at this chart. Susan, I'm going to let you go ahead and like dive into what that means for if you really are shooting for fire, and other ways people can take a look at this chart.
Yeah, I think even to your point, you can add side hustles in there, right? So if you think about, if you could take on some consulting or just working part-time and you could make $1,000 a month, $2,000 a month, that reduces the amount of money that you need, right? So if you needed 5,000 a month, but you've got some consulting work now that's going to bring in a couple $1,000s a month, well, now instead of having 1.5 million invested, you only need under $1 million invested. So I think that's another way to look at it too, that maybe isn't quite so daunting as needing the full amount of money. And then another thing to think about too is this needs to be investable money. So we've worked with clients who, they've come to us and they have like 3 million tied up in their house and they have no interest in selling their house. They want to leave that to their kids. But they're like, I have enough money to retire, but really they don't, right? Because their house is not an asset that's producing income for them, right? So if they had 3 million in the stock market, then yes, they could probably retire. But because it is tied up in a non-income producing asset, they cannot retire yet. So that is something to think about is this money in investable assets? Where is this money tied up? Is it working for me? Because that's fundamentally what we want our money to be doing, right? It always needs to be working for us, always making more. And that's the point of investing. So I think, this chart can be really helpful, but like Caitlin said, there are a lot of nuances to it. There are a lot of ways to look at it, but it's a good place to start in determining your early retirement financial freedom number for sure. I know we're getting a little bit low on time, so I wanted to get to a couple more questions in the chat here. One was, how do you plan ahead financially when you are first starting a business? Caitlin, did you want to tackle that one?
Yeah, I think that's That's such a great question. It's really exciting for someone who is planning ahead in that way. And I think that it depends on a couple of things. One is what your plan is to start this business. Are you going to do it as a side hustle in addition to your income? And if so, I would say that's such a great way if you have the capacity to do that. Obviously, that's not a great option for everybody. But being able to do that allows you to get started in your business and really make decisions about how you want to spend that kind of money to start the business, where your expenses are going to be coming from. Can you fund some of those expenses just based on your other take-home pay, or are you able, to find alternatives rather than having some of those expenses? I know that a lot of times, you can opt for fewer business expenses if you're willing to put in a lot more time to kind of manipulate a process on your own, or really, even when it comes to like uh, growing your customer base. There's a lot of time and money that can be put into that. If you focus a little bit more on time, it could have the potential to save you some money. I think that when it comes to budgeting for starting a business, though, it's, the same goes for when you're budgeting for anything. If you have the opportunity, if you've done the expense tracking and you could see ways where you can reduce some of your expenses, that's great. I also think that if you're in a position where you're like, look, this is my dream, I know it's going to take this much money to start, I have to start, scaling back some of my investments to do that, then do it. Like, that's your dream. And you're still investing in yourself and your future. So if it means that you can't invest as much as what you're doing now, then that's okay. And we talk a lot at Rising Femme Wealth about the seasons of financial freedom. I mean, we have seasons um, of craziness in our lives, seasons where we can't focus on ourselves as much. We're also going to have seasons where financially we're not feeling like we're killing it, and that's okay. You can have seasons where you're like, wow, I was contributing so much to my retirement plan back then, and I had to stop because I realized I really need to start this business. It's something that I feel like I'm like called to do this. It's really going to fulfill me. And I know how much it's going to cost. And therefore, one of the ways for me to build up that egg is to stop or scale back on my investing. That's okay. Do that. Take advantage of your financial seasons. This is an opportunity for you to follow a dream and make yourself happy. And it's an investment too, and it has the potential to pay off even more. So I would say don't feel bad about doing that. It's not a wrong choice to make. Susan, I don't know if you have anything that you want to add.
Yeah, I agree. I would say, when you're starting out, an important thing is to definitely have some financial reserves, especially if you are planning on leaving your job. Really, I mean, with any business, even, if you're buying a rental property, right, you can have all sorts of expenses that come up. So just make sure that you have some sort of emergency, like contingency fund there. To cover any unexpected things, but then also try to take advantage of resources that are available in your community. So the Small Business Administration, SCORE does free business coaching. There are probably, venture capital organizations. You might be able to get into an accelerator, an incubator. There is a lot of free business assistance out there, especially for small business owners, women business owners. I'd say definitely get connected with those people and take advantage of that for sure. We have another question in the chat. I know this is a big one, but we'll try to keep it sort of short. How do I invest in real estate for rental income?
I love this question too. It's a great question. I think the chuckle is just because we're like, oh, there's so much I can tell you about this. We don't quite have the time on this call to go into it all, but I do want to definitely be able to highlight a few of the big points here. So first of all, I think it's one thing I will say, and I actually do have something I can share really, really quickly. I'm not going to speak the whole time to this. pull this up really quick. So why would you invest in real estate for rental income? If you're in a position where you've been able to save money, if you've already taken advantage of some of the investing benefits that we've talked about, like obviously make sure that you've paid off your high interest debt first. Make sure that you're meeting your company match. And, if you have, if you're eligible for an HSA, that's a great way to invest. When it comes to then going back and maxing out contributions to your employer-sponsored retirement plan or IRA, one thing I will say, when I started out my rental investing career, I actually scaled back on how much I was contributing. So I was meeting my match. I did have an HSA. I was maxing that out, but I wasn't maxing out my IRA contributions every year, and I wasn't maxing out my 401k contributions every year. And the reason is because I was really trying to save a lot to buy my next rental. So I was on like that savings path, and going back to that kind of like, if you're saving up for trying to start a business, I was definitely gung-ho on really leaning into this rental business that was just getting started. And I really wanted to be able to save up for a down payment. So that's what I started to focus on. Don't abandon other investment vehicles though. So if you do have benefits that are low hanging fruit that are available to you that you can still invest in, still feel free to do that. But why would you invest in real estate? Real estate provides cash flow. So like Susan said, your $3 million house that you're living in is not necessarily providing you cash flow, but when you're buying rentals, and if you're like me and you're someone who lived in a house that cost way less than your rentals did, but your rentals were the ones generating income, you can start to appreciate what income generating assets really can do for you. So cash flow is one of the big reasons that people invest in real estate, but tax benefits is probably the biggest because you get so many opportunities for depreciation, as well as being able to deduct a lot of business expenses when you have a rental business. You have the opportunity for appreciation, and the real estate market appreciates a little bit at a slower rate than what we see the stock market return. But when you combine cash flow with appreciation and the ability to do this fourth thing on the chart, which is take advantage of leverage and loan pay down, it means that you actually are able to acquire an asset that's worth so much more than what you've paid for that asset. And you're able to pay down the loan on that asset thanks to the rent that you're getting from your business. You're still getting cash flow on that, and you're still able to benefit from the long-term appreciation and tax benefits every year. So I'm sorry that was so fast. Usually when I talk through this, it's a little bit more deliberate, but these four elements combined really make real estate investing such a powerful way of investing. And by the way, if you go to our website or even just reply to when we send out the recording, you could reply to the recording, but search for our masterclass. We have a free real estate investing masterclass, and it just shoots you a video that goes into each one of these elements so you can learn a little bit more. But I'm gonna just take this down so that we can focus a little bit more on what are ways that you can get started. First of all, I'm going to talk really quickly about rental strategies, because house hacking is a strategy that I think is such a beginner-friendly strategy to real estate investors. It's not available to everybody, because here's what house hacking is. It's when you actually have a property that you're living in that you're also renting out. So that might sound a little strange at first, but hear me out, because it's not just about renting out like a bedroom in your own home, although house hacking does include that. And that's what I did when I first started. Although, of course, I rented it out to my good friend. She was my roommate. But you can also buy a duplex and live in one side of the duplex and rent out the other. So why would you do that? Because you get lending advantages if you are buying a primary home. And if you're living there, it's your primary home, even if you have 3 units attached to where you live and you're able to rent out those 3 units for extra income. So I think it's friendlier on the budget, especially if you have the opportunity already to say rent out, maybe if you have a separate entrance in your home and you're able to say, you know what, we're going to lock that part of the house down and rent it out. That's house hacking. Or if you're able to say, I'm ready to move into a duplex or some other small multifamily unit, and I'm going to get great financing on it, and then I'm going to live there and I'm going to rent out the other units. That's called house hacking. It's a great strategy for real estate investors. It's not for everybody, and not everybody's in a position where they want to move or are able to rent out part of their home. So there are also, the long-term rentals that everybody usually thinks about when they think about real estate rental investing, and that's usually my bread and butter. Short-term rentals as well, like Airbnbs. And Susan and I have both done a lot of short-term renting with some of our properties. And then fix and flips are not a rental strategy, but when people say that they want to get into real estate investing, a lot of times they have questions about fix and flips. I think it's another whole nother beast. I will talk a little bit more about that on another call when we have a little more time to get into other real estate investing strategies. But when it comes to taking the first step, because I understand that is the hardest part, already talked about like the analysis paralysis when it comes to investing with our retirement plans. When it comes to real estate investing, it can feel even scarier because there's really, we don't have just like a standardized market to invest in. You're taking on these properties on your own. You're putting your name on a big piece of debt, and you're responsible for the living situation for other people. That's really important, and that's not a responsibility that any of us should take lightly. But if we can enter into it responsibly and make sure that we're really being diligent about identifying all of our expected possible expenses, both recurring, one-off, and long-term or future expenses, and making sure that we're trying to account for as many of those as possible and being as accurate as possible, as well as trying to account for possible income from a conservative perspective, and also doing the research to make sure that that is as accurate as possible, then we can really get into a great position where we can say, I really think that property would make a great deal or not. So it comes down to making sure that you're doing the research. I think that it's important for you to get solid on what your budget is, and then also what kind of time commitment are you willing to put in. If you want to be hands-on, and if you think that you have the time and the capacity to do that, that's great. If you don't have the time to do that and you don't really want to be hands-on, budget a property manager. I think it's always a good idea to budget a property manager because you might change your mind about that time commitment. And then get clear on what your goals are. Are you looking to get into a market so that it can appreciate over the next 10, 15, 20 years? Like maybe you want to have an appreciation gift to be able to give your kids to go to college, and your timeline, you have a longer time horizon for that. Or are you looking for like being able to turn something around really short term? You want to buy some properties now and then be able to sell them in the next 5 to 8 years for a really good profit. Or maybe you're just looking for a market that is going to cash flow and you want really good cash flow right now. And that might mean you need to go to a cheaper market that has really solid rents, where you might have to put in a lot more work in terms of maintenance and potentially, renter disputes and making sure that your renters are really happy in a property that might be a little bit older. But if that's what you want, you need to really understand what your goals are, and then make sure that your markets align.
I have to plug our real estate calculator that we have on our
Yes.
site.
Yeah.
So Bigger Pockets actually used to have one of these for free on their website, and now you have to pay for it. So we built our own. So you can actually run property details in that. So if you go to risingfemmewealth.com, you'll see calculator at the top, and you can put in property details, expenses, and it will actually run the numbers for you on cap rate and cash flow. And you can have a report emailed to you with even more information about these deals. And so it's a great way to start, just sort of back of the napkin, running some of these deals to see if they would make sense for your investment portfolio. So that's my little plug.
Totally. No, totally. I mean, that's such a great tool because that leads into one of my next points, which is take the next step by practicing. And the way that you practice is to look for deals in the market that you think you might want to invest in and make sure that they're within your budget and determine whether they meet your criteria. Are they going to drive enough cash flow for you? Do you think that they'll appreciate enough so that in 3 years, 5 years, 8 years, 10 years, what does it look like if you were to go and sell in those timeframes? How much money would you be putting into the sale and how much money would you be making in the long run on that deal? So just start practicing. Use the deal calculator to do that practice. And then I would also, I recommend people talk to some lenders, not just one, but talk to a few different lenders to see what your options are based on your budget, based on what you can qualify for, and not just one lender because you want to get comparisons of different rates, but also different fees. There are always a lot of fees that you have to factor into a deal when you're doing lending. So make sure that you're talking to a few different lenders about that, but start by practicing. Use the deal calculator.
And I will say, Caitlin and I both reached financial freedom primarily by investing in real estate. It really accelerated our wealth growth and allowed us to build wealth quickly. It is scary getting into it, and I certainly had no idea what I was doing when I bought my first rental property, but I had just had my first child and I asked to go part-time at work and they said no, and I realized I needed another source of income. And so that's when I bought a duplex and started my real estate journey. And that was 15 years ago now. So I think, a lot of it is just running the numbers, finding something that works, and then jumping in, even if you don't know everything right at the outset. I know we're running tight on time, but I did want to get to one last question that I got a lot at the Texas Women's Conference. I had a lot of women coming up to me telling me that they felt like every financial professional that they talked to was just trying to sell them a product. And where could they go to for unbiased advice? Well, they can come to us. Financial professionals, this is typically how they make their money, right? They are making money off of your money. So they are trying to sell you products that they get a commission for, they get kickbacks for, referrals for. Because Caitlin and I are both financially independent, we are not dependent on any kind of commissions or kickbacks or association with any product. So we are here to provide support for women on their financial investing journey. And we have no vested interest in any particular investment. So
yeah, I should clarify that financial independence, like, yes, we're financially independent and we want that for all of our clients, but our what we mean here is that we are not selling any sort of financial product. We're not affiliated with any institution or product. So for us, when we find that there's a strategy that we think will work for somebody, we talk through that strategy with them, and never would get a kickback for any of the products or strategies that we help our clients look into.
Definitely. Yeah. So our goal is to provide unbiased and customized support for women. It was something that we felt was lacking along the way. We had a lot of skeezy financial professionals trying to get us in investments that just weren't right for us, or they didn't understand our situation as, a working mom. Right. And so we felt like no one really got us. No one really had our best interests at heart. And so that's the service that we are trying to provide for other women, is someone that really has your back and will say, hey, this investment probably isn't great for you, or yes, this one looks like a good fit. We've looked through the numbers. So we're just here to be support, to lean on. And if you're interested in learning more about that, if you want a more customized solution, we do have a couple of offerings for you. Caitlin, do you want to pull up the slide QR codes? So we have two main offerings. We've got Investing 101. So this is our inexpensive crash course on investing. You can learn investing basics. So if you're just getting started, this is a great place to start. So you can learn about all the different types of retirement accounts, how to get a taxable brokerage account set up, and why you should be investing. What are the benefits of that? And then we also have our annual Abundance Circle program, and this is to provide community support for a group of women who need a safe space to talk about money. We provide financial literacy education, we provide tax strategy, and you also get 4 one-on-one coaching sessions. So we work through your holistic investing plan. We start with your goals. Where do you want to be in your life? What do you want to be doing with your time? Do you want to spend more time with your kids? Do you want to be able to travel? Do you want to be able to work part-time? All the different things that you see for your life, and we incorporate that into your financial plan. How can you actually get there? So we do the one-on-one coaching in addition to group coaching sessions. And in those group coaching sessions, we do education. We also do clarity writing. So we'll be writing, what's swirling for you right now, and how can we get you in a place where you're feeling good about everything. We do vision calls. So what are your goals? And then, of course, the investing and tax strategy deep dives. Tax strategy is my specialty. And so I really like to help women figure out how we can reduce that tax bill, because that's such an important piece of wealth building. And then, of course, we provide accountability. The whole group provides accountability and community. A lot of times women are told it's rude to talk about money, but we want women talking about money. Women talking about money is how we grow and build our wealth. So that's what we're trying to achieve here with the Abundance Circle. So we've got QR codes to both of those offerings. You can also find out more on our website. And I appreciate everyone coming today. This has been great. I appreciate all your questions. And if you think of any more questions, feel free to just shoot us an email. And you can find us on the website, and we'll do another one of these calls again, and maybe next month. And Caitlin, do you have anything else that you'd like to add?
No, I echo the thank you. And you can always respond to one of our newsletters. You can hit us up at hello@risingfemwealth.com. You can DM us in Instagram or Facebook. We really do love hearing your questions, things that you want us to dive into more. If you email us a topic that we think a lot of people want to hear about, then there's a good chance that we'll do a newsletter on it. So don't be shy. We really love hearing from you, and we appreciate all of these questions today.
Yeah, it's been great. Thank you, everyone. And we'll talk to you soon. Bye.